Hi everyone, I'm Rick Bensignor. Today is Tuesday, September 8th, and welcome to this week's In the Know Trader show. This week, our agenda is going to include our trader education portion, where we're going to discuss the old theory of woulda, coulda, shoulda, and what that means in the marketplace. We'll do our weekly markets overview. And then, of course, given what's going on in the markets, let's take a look at some of the popular tech names. So these are going to include the FANGs and a couple of other widely held tech names that you certainly may have exposure in, and how those charts look. So we'll take a look at those. Let's start off with our trader education and this whole idea of woulda, coulda, shoulda. So let's think about this. How often we hear a colleague or somebody say, well, I would have bought it. What's it? Well, I don't know, stock XYZ. If only I had such, and then you get some story. And similar to that is the coulda, as in I could have bought it, but I had to run to the supermarket, and by the time I got back, I missed my entry point. So I'm not a part of this rally. And then there's shoulda. And shoulda is really the one I want to kind of spend some time on, because of the implications of what shoulda, as in should have, really means. So let's go to, I looked up should in dictionary.com, and it said it's the past tense of shall. So let's take a look at what shall means. Number one is a plan to, intend to, or expect to. So when I say I should have done something, it basically means I plan to, I intend to, I expect to do something. If it was in the past tense, as in should have, as in the words we're using, woulda, coulda, shoulda, meaning should have, then you plan to, you intended to, you expected to do something. Let's look at choice number two. Will have, to, is determined to, or definitely will. So when I should do something, it kind of implies that I'm determined to do it, or that I will do it. Number three here is must, or is obliged to. And then fourth is more as a questioning, and that we don't need to look at. So should have. What's that mean in a market sense? And what's that mean as far as your intentions of doing something, and the difference between I should do something versus I want to do something? And I think back to this because I think of this a lot in terms of, let's say, doing logical things in the market versus doing right things. What are right things? Well, right things are what makes you money, ultimately. So all the other things or excuses don't really matter in this game. What really matters is making money, right? That's why we're in the market, is to make money. So I think back to a couple months ago when the market was strongly bouncing off of the March bottom, and I had put out a reduced long exposure call, let's say, in between roughly 3,000 and 3,175 in the S&P. Now, the way I look at that is that was a logical thing to do, and I came up with that based upon a whole bunch of work I had done. I studied the past. I looked at levels where resistance should be, and if I remember correctly, there were 7 different indicators or moving averages or some type of something we put into the technical category saying that this is a place the market should stop and reject and pull back from. And it stayed there in that zone almost 2 months, but it ultimately pushed itself higher. So the conclusion of that whole sideways pattern was a push higher. And that push higher was what led ultimately to keep going higher and making the high a week ago. Last Wednesday's intraday high, if I remember, is now the all-time high. And I bring this up because logically, reducing exposure where we did was a logical thing to do, although ultimately it didn't make me money. It cost me a little money, not a lot, but opportunity cost, because it lightened up and had clients lighten up only to see the market move higher. And when we got back in, we got back in higher than where we had reduced our exposure. So we lost the potential profit we could have made if we had still been long the entire X amount of exposure, whatever that was. And to me, that was the logical thing to have done, given how low the market had sold off to in March and what the potential bounce was, and the COVID virus and economic numbers not coming out strong, et cetera, et cetera. And I told people at the time that this is a logical decision to make. It may not work, but it is the logical thing to do. So I put that into the category of that is what I should do. It was an intelligent, well-researched decision that I made. Now, the lesson from it is that you can think logically all the time in the markets, but thinking logically doesn't always make you money, because the market, which is a compilation of individual investors, some institutional and some individual, but collectively the market can certainly act irrationally, and it can act irrationally for far longer than people expect, or you necessarily could even afford from a dollar point of view. In other words, you could buy a stock that keeps going lower than where you bought it, and it was very logical to have bought it where you did, but you still may not be making money on it. And this is, of course, what happens all the time to analysts on the street who will upgrade a stock and say, here, buy it, and 3 months later it's down 10 or 20% lower than where they told you to get in. So there's logic, and then there's the market doing what the market does, which is to mess up as many people as often as it can, which is why we concentrate so much on behavioral finance and try to understand that whole process, that the market can be irrational for long periods of time, and that the goal would be to understand how irrational it can be and take advantage of many moves that occur in the marketplace that are beyond logic. So we think logically, and then we also think, okay, what happens if logic doesn't work? Where might a market go to? Where does it exhaust itself? And where can we kind of pick up stuff really cheap or sell stuff, what I'll call as expensive, not necessarily in terms of dollar valuation, but just in terms of its relative chart movement, which is why we tend to buy low and sell high. And this all mixes into what happened in the market last week, and the fact that the S&P got to our 35.55 to 35.95 target, which was there's only one other target I have in the 3600 handle as being anything that's near where markets were trading. And I personally sold a fair amount of stock last Wednesday going into the close, because to me, it was what I should be doing. It was the logical thing to do when I put all my signals together. This was a place that to me made sense. And not just like a shot in the dark, but I had multiple targets, multiple time frames showing upside exhaustion. And the fact that nothing had really improved on the virus front, other than the fact that the market had moved up so much over the last few months, but nothing had really improved when it came to just the economy. Numbers are still high, and this weekend, obviously, when you look across the globe, the Labor Day weekend was not a good weekend when it comes to COVID and the implications of just how many more people are getting sick. And I've got a couple of kids still in college, and as parents, we worry about how they're going to do. in universities that have 50,000 kids or more, which is where they both happen to attend different universities that have very large populations. So there's logic, and I try to think of things in terms of, is it logical to do what I'm doing at any particular time, as compared to, do I simply just want to do it, or is there logic behind it? The logic ties into the woulda, coulda, shoulda. Is this something I should be doing? And if it's something you should be doing, and you put your, you don't just shoot from the hip, but you put your well thought out research together, and something says this is what I should do, then at least 9 out of 10 times, I'm going to do what I should do based upon the research I do, because logic is an important way of looking at the market. And even though we know the market can be illogical and irrational at times, I stick with what makes sense in looking at, like, what should I be doing? And I just thought that this was worth some time to put into as I try to set up, some each week when we talk about our trader education portion, that this is something you should be thinking about. Forget the would-haves, forget the could-haves, concentrate on the shoulds. What should you be doing? And it may work out in the market or it may not, but I think you'll do better over time when you have enough information that comes together that suggests you should be doing something. And that's my thoughts for today. I hope that you can get some value out of that, and think about that as you go forward in your trading. Okay, let's move on from here. To contact me, it's Rick at inthenotrader.com. Of course, inthenotrader.com also, the website itself gives you how to access and subscribe to the 2 reports that we come out with. We have a weekly tactical trader report that comes out every Wednesday night with a review of what's going on generally in the S&P, the 10-year, maybe the gold or the US dollar market. And then we give you a new trading idea each week in an ETF. This is solely ETFs, not individual stocks, but ETFs. So we give you a new weekly play each week. And I'll review every open trade we have, going back as far as necessary until we get out profits, getting stopped out, whatever it is, as long as we have a position on. We will walk you through it in update levels every week. The monthly 7-Eleven report just started August 1st. Its goal is to outperform the S&P by being in no more than 7 of the 11 macro sectors. That comes out on the 1st of each month, and this is taken off like wildfire. So subscriptions have been very good, and we continue to get new people. So for those of you who are not looking to trade the market, but to invest in the market, so this is a full medium-term type of hold. It's not in and out in 3 days or 3 weeks. This is meant to outperform the market over time by eliminating investments in the sectors that underperform. And that's our goal here, and that's what we aim to do. And the monthly 7-Eleven sector report is out and available, and I suggest you take a look into that. Okay. Let's start our weekly analysis, comparing last week's performance in the 11 sectors versus the week before. Clearly, technology was the big loser over the last week, gave back over, 600 basis points, something like that, in performance, as they really took the air out of the balloon in the tech sector. The only other sector that really materially underperformed last week was discretionary. So you did take 2 out of the 3 sectors that are outperforming this year were hit. And of course, the recipients of that rotation were the bulk of the other sectors. So you can see 1, 2, 3, where we have 6 sectors picked up at least 1% versus the S&P last week. Interestingly, energy barely moved. So the dog continues to be the dog and is still underperforming the S&P as of last night's close by 47% this year. It's just astounding what has gone on in the energy sector. And you would think on a pullback like we're seeing in the market that energy would get some type of bid just because so many of those names are cheap, and yet through last night's close, it's barely moved from the week before. But you are seeing some rotation here as the market finally has pulled back. But think about this. Right now, as I speak to you, the S&P is trading at 3355, and that is below what had been all-time highs previously, but it's not much farther than we were, I don't know, I'd say just 2 weeks ago, 3 weeks ago at most. So even though the market's come off over 6% since last week's high, we're just back to where we were a few weeks ago. So in the scheme of things, it has not been, a material sell-off yet. All right, let's look at some charts. So it's not where I wanted to start. Hold on one sec. There we go. Okay, so with minimal marking up, here's the S&P chart, and again, using other things, I'll show you actually in a second. I'll show you the monthly chart. How we kind of identified this area right in here, where there's a daily chart, but why we had that as an upside target. What's important now is just looking, there is a trend line that we're playing with. We're a little bit beneath it. We bounced off a bit last Friday. We're a touch, beneath it now, but that's, one thing to pay attention to, as well as the fact that we are beneath what had been those prior highs from February this year. I'll show you the monthly chart, and here you can see the propulsion exhaustion level is essentially right by the high, and that's why I did some selling myself last week. I had multiple reasons to do some selling up there, and again, that's what I felt like I should do. It might have worked, it might not have worked, but I try to stick with when the opportunity comes and you've done your homework. If you should do something, do it. So far it's paying off, and whatever I've sold up there, I certainly have a chance to buy back lower, at least for now, and that's how I'm looking at things. Let's take a look at the US 10-year just on a daily chart. Most people have this as an upside breakout, whether, whichever trend line you wanted to look at from the March high, that yields are starting to break out to the upside. And I've told people that we have not broken out yet, and we still need to trade higher in order to get that breakout. Again, if you subscribe to In the Know Trader, you will, especially the weekly tactical report, you'll get the levels that we're looking at in order to know when the bonds have actually broken to the top side, as well as where, for instance, the S&Ps, where, for instance, I'd consider coming back in, and where I think the important support zones are. I'll give you a quick look here at gold 2 on a weekly chart. It has stalled against the set of 9 that followed this 13. We've pulled back to this red line represents what had been the all-time high back from 2011 when gold got to, I think it was 1924 or so, in front month active futures. So that's what this red line represents. So you can see that since we've pulled back, we are holding above what, we're finding support at what had been all-time highs in the past. If we get beneath there, then you have a chance to get all the way down into that 1800 zone, which is a level that plus or minus, I don't know, $10 or so had been a place that we had found significant resistance in 2000, I think it was 2011 and 2012, after the market had made its all-time high. And then let's just take a look at the US dollar. Do I have it here? There we go. Here's the weekly dollar chart. And one of the things that I'll tell you when this comes up here is how important it is to keep long-term trend lines on your charts, because the low in the dollar is being made. It was made last week. It was on a setup 9 count. Plus, it was against the uptrend line from the 2011 low. So that's what also helped me identify that there was a very good chance that the dollar would get a bounce. Now, the dollar's still heavy, and there are different places, one could sell into on the rally, but for now, there is a good short-term bottom in place, and until you wash out the too many bears on the dollar, the dollar still has a chance to rally. These other lines were downtrend lines from all-time highs, and this actually is the one from the pure line from all-time high, and this is the one from the secondary high. So you can see also that what was supposedly a breakout in March when stocks fell and the dollar rallied, well, yeah, you got some breakout, but you never took out the line from the all-time highs. And that's why, long-term trend lines are important to keep on your chart. Shorter-term ones you can get rid of. Longer-term ones I tend to keep on because they're helpful. All right, that's it for looking at the markets. Now let's look at some individual stocks in the technology sector. So we're going to start with Apple, and these are not in a particular order. They're not even pure alphabetical. It's just about a dozen names, give or take. So we've got 7 minutes or so we should be able to get through most of them. So let's start with Apple here. Weekly, all these will be weekly charts. Notice the 13 sequential top that this called. The last time it called for an exhaustive top was January of this year. So the last 2 at least have been spot on. This one here in the middle of last year kept you sideways for, 6-7 weeks or so before it started going higher. So exhaustive signal here, that matched up with the S&P having an exhaustion signal and the Qs having an exhaustion signal. So, and no surprise too, because Apple's obviously, one of the biggest weights, if not the single biggest weight. I guess it probably is the single biggest weight pre-split. Well, even after the split, it's still one of the biggest weights. So anything that's cap weighted, it is. So that includes both the NASDAQ and the S&P. So where important support, let's just see if anything's going to cloud too. Okay, so we are starting to get a little bit of bottoming into the clouds. This is the weekly clouds conversion line. That is the first level of support on the cloud model. If it gets through here, then first downside target is, what do we have here, 109.17. Second support is at 95.5-ish or so. Those would be places that if you want Apple for the long term, those are support places to consider coming in and doing some buying. Amazon also with a 13. This is actually trading beneath its first level of support right now. We'll see how the week goes out, but if Amazon comes off more, it could get down to 20, something right near 2,800 or so would be the next significant level down based upon this chart. Notice the cloud, price action has always been above the cloud. The lagging line's always been above the cloud. It's been obviously a huge home run type idea and name. MACD is getting closer to crossing. And if it does, you may very well get a push lower. But for now, at least you get the feeling that some type of trading top is certainly in place in the market and these big cap names. Microsoft didn't get a 13, but made a new all-time high. It sold off well beneath its initial support line, holding propulsion exhaustion here at 203.77. So we're above there. That's good. A couple of Friday closes beneath there would open the door for a move down to, right now it's 182.69, but this will probably move up a little bit over time. So you got to always keep the cloud charts up to date, look in real time. Here's Netflix. Notice that Netflix had made its all-time high back in July. So we kind of have a shorter term double top. We are beneath the conversion line. So these two, there's still potential places to pull back and buy into support. Notice just by chance that the conversion line here at 433-ish is just not far away from what had been prior all-time highs. So, somewhere down in there is a place I'd consider buying into. Also, if you think the long-term trend is up, which it is on all these names. Google. So this is, obviously the stock's name is Alphabet. We know it is Google. This is GOOGL. Again, all-time high last week, trading beneath its conversion line, still leaves it somewhat vulnerable for a move down to 65 as first level support. Clearly a great name and a stock that remarkably recovered from where it was years ago when people had written off Microsoft as an old company. Google. And this is, again, places that you consider buying into. Facebook. Set up 9 on the bottom this year, set up 9 now on the all-time high. I'd at least look for it to get down and test first level support here. You can notice the cloud conversion line caught the low in here, caught the low in here. We'll see if it holds above 266-ish or so. Otherwise, next level down is about 257. But again, good near-term top. Nothing wrong with taking some profits, folks. All these names show the same type thing that, we clearly have a trading top, and it's a question of how low they go and what are you willing to, if you own the name, what are you willing to give back? Here's Tesla. Crazy run up when they announced the 5-for-1 stock split. Ridiculous how much the market moved up above, gap down. To me, if I had a chance near the baseline, this thing got down to the, 286-ish or so. Certainly a place I would consider doing some buying, but this is super volatile name. So you got to be prepared for wild swings in the name. NVIDIA, great name, peaked last week. Again, holding some kind of first level support. If it breaks, look for 421-ish and then 385-ish as possible other places if you want to come and be a buyer. Otherwise, again, like all of these, you might not have sold the high, but nothing wrong with taking some profits. Well, it works well. Let's look at Zoom. Zoom obviously has limited trading history. Huge move up last week. Look where we are relative to last week's high. It's huge percentage move. But next support isn't down till near 290. So I actually, frankly, don't have much I can do with this name right now. BABA. All-time high last week, holding first level support. You see how much these things trade together, how similar charts are on a lot of these names. That first level support from the conversion line is on many of these names where we're trading. And the last one is CRM, Salesforce. Last week, all-time high, pullback. I'd look for this to still trade lower, to at least come here, look even here on the whole move up. That's my timer telling me I've got 30 seconds. So look, this thing climbed up the conversion line. So I'd look for support down here. I don't know. I have no idea if it's going to get there, but you can see the levels are 233-ish and about 204 plus or minus a few dollars. That is it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this is In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.